Hello, this is Bob. Today on this lecture we will take a look at Chapter 6 and we will talk about inventories and cost of sales. So we're going to determine inventory items first. So merchandise inventory includes all goods that a company owns and holds for sale regardless of where the goods are located when inventory is counted. So what that means is inventory is the items that we intend to sell within the business process. So we are buying and selling items or manufacturing and selling items, and the inventory for one company may be different than another company, or in other words, one item being such as like a car could be inventory for one company, whereas in another company it would be a fixed asset. For example, in a CPA firm, a car would clearly be a fixed asset. We're not selling the car in the normal business process. On the other hand, if we're a car dealership, then the cars are, of course, inventory. If we own the inventory, we need to count it in inventory, even if it's not in its traditional location. And those are some of the items that we need to take a look at and have special attention to. One are the goods in transit. We'll talk about what happens when we're buying inventory from, say, a vendor and it's on the way to us. Then is it included in our inventory? It's not in our warehouse yet. We'll talk about that. Goods on consignment. Consignment means that one company is putting the goods into another company's store or warehouse and the other company is selling it, even though they do not own it. So the original company owns it, and it's being sold at a different store or a different location. So where do we put the inventory on that? How do we deal with that? Because the inventory is going to be in a different location. And then goods damaged or obsolete. What happens if a good, gets damaged? What if the car breaks? Then what do we do on the inventory? What happens to it? These are questions we want to take a look at. First, goods in transit. So if the seller is going to transfer the goods to the buyer, we in this case being the buyer, when do we record it as the buyer? If it's FOB shipping point, that means that we are taking control of it when it is shipped. So the seller's over here, we're the buyer, we are basically in charge of the shipping. We are hiring the courier, and if the courier gets robbed on the way to us, we are liable for it in that case for the most part. And therefore, the inventory should be counted on our books, meaning we debit inventory, increase in inventory, credit accounts payable, when the courier picks it up from the seller's location. On the other hand, if it's FOB destination, then the seller has responsibility as it is being shipped, generally has responsibility for the shipping, and then when we receive it, we don't record it on our books until we get it and count it, right? So when we get it in our warehouse, we debit accounts receivable, we debit inventory, increase in inventory, and credit accounts payable at that time. Then if the truck got robbed on the way, generally it would be the seller's responsibility. So this can be a big deal, and it can have a big deal in terms of who's liable for the inventory in transit. It can also have a big influence on the financial statements, because if the inventory is in transit, that can be a big difference in terms of our financial statement reporting as to when we report these inventory on the books. So goods on consignment. Merchandise is included in the inventory of the consignor, the owner of the inventory. So if the consignor owns the inventory and they give it to a consignee who then will sell it and give part of the profits to the consignor, the person who originally had the inventory, is the one who records the inventory, even though it's not located in their location, it's located in the other location so it can then sell. For example, I worked at a restaurant, a Mexican restaurant, one time I did bookkeeping for a Mexican restaurant, and they would have paintings on the wall that from various artists in the location. The paintings on the wall were not owned by the restaurant, they were owned by the painters who would then display them in the restaurant, so they would not be included in the restaurant's inventory. The restaurant would then sell these paintings if any of the clients wanted to buy them or any of their customers wanted to buy them, and then they would pay the painters and take a portion for the displaying of it. Therefore, the painter would basically have the inventory. It's still theirs. It's still their inventory, and it is not the inventory of the restaurant in that case. Goods damaged or obsolete. Damaged or obsolete goods are not counted in inventory if they cannot be sold. Cost should be reduced to net realizable value if they can be sold. So generally, on almost all of our accounting ideas are going to be the idea that we would rather underestimate ourselves, meaning we'd rather underestimate assets than overestimate. We'd rather overestimate liabilities than underestimate. At least that's the idea of the regulations behind financial statements. Why is that? because we don't want to deceive our readers in a too positive way, because companies have an incentive to make themselves look too positive, and the regulations, of course, then are geared towards the default being on the negative side, meaning our assets would rather be understated than overstated in terms of generally accepted accounting principles for the most part. So inventory then, for example, if we can no longer sell the inventory, then it shouldn't be included in inventory. If the inventory can be sold, but it has now decreased in value, meaning it's decreased below what we bought it for, meaning we're not going to make a profit on it. Not only we're not going to make a profit, we're going to have a loss on it. Then we need to reduce the value of the inventory. So we generally record the inventory at the lower of either the cost or the market value, the realizable value, the value that it could basically be sold for. So we have to write that down when that happens. Why would that happen? Damaged goods, it's old inventory, obsolete inventory, and this is a real problem in audits and engaging inventory. I've audited companies that sell clothing and clothing material and stuff like this, and sometimes I've seen that they have material in there from the 70s, or something, and the cloth is still good, it's still good material. The question is, has it gone down in value? Could they still sell that for what they bought it for, even though the pattern is kind of out of date now? And sometimes you need experts to come in and make that determination. So the accountant might have to go somewhere else and find an expert to say, what is the value of this inventory at this point in time?